Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Thursday, my God, October 23rd. This year has gone way too fast, and it is 1:42 p.m. Pacific time. And this is the next episode of Investment Friday. I am here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. And Brad, you're going to have to take over because apparently I can't talk today.
That's okay. That's okay. That's what happens when we're in the third week of the government shutdown. Everybody gets a little bit tired as we're stressed out, wondering what the economy's doing. No, I'm just kidding. It happens every once in a while, particularly on a Thursday afternoon after a pretty decent week. So
It's been a little crazy, and I can't really think too hard about this, but next week is Halloween here. My kids are 14, 12, and 10. They're still super into Halloween and have their costumes. Like my two older kids have most of their costumes ready. My youngest, she needs her costume still, but we're in a new neighborhood, like all the things, right? Like see what it's like. But yeah, that the fact that Halloween is literally next week is kind of blowing my mind because that's the end of October. We done. October will be gone.
we're officially into the holiday season, right? I mean, we're a week away from Halloween, which confectionery and candy sales up. That's when they really spike up as everybody prepares for the trick-or-treaters coming around. Then we roll into November with Thanksgiving and really the beginning preparations for the holiday season, gift buying, whether, no matter your religion or your practices, generally that's a period of time, November, December, where you're buying a lot of gifts for your kids and your loved ones. So, knock on wood, hopefully this is a great holiday season. So that a lot of people can work and feel productive and enjoy their family and their friends.
Well, you mentioned the government shutdown, and that is still going on. It started officially October 1st. Again, it's October 23rd at this point. So, one of the statistics I saw is that this has, I think, now reached the longest full government shutdown in history. Correct me if I'm wrong on that, if someone sees something different. But at this point, full government shutdown. The ones before that were longer were partial. So some parts of the government were still running. This has been a full shutdown. And with that, we've talked about this for the last couple of weeks. One thing that's not happening is we're not getting a lot of data. So from our normal data sources that, economists and, you know, Wall Street traders and hedge funds and all those like that people use to, kind of know where the economy's headed, how, take the pulse. So yeah, what are you seeing there? What are you looking at now that we're in week 3 of the shutdown?
Yeah, I mean, we're trying to well, first of all, it is very difficult to understand what the economy is doing when you don't have data coming out. Okay. Now, I will say the Federal Reserve is still at work, right? Because they are a government agency, but yet they are also a bank. And
Hmm.
so they can fund their own expenses outside of any federal government uh, um, action, right? They already have their salaries funded and all that. So they are on top of the pulse. Now, some of the data they rely on is not getting to them as the Bureau of Labor Statistics and a bunch of the other agencies that collect and parse through the data are not at work. And so one thing is tomorrow we have the inflation rate that's coming out. And hold on, I believe that's true. Let me really quick.
And while you're looking for that, one of the things, and I mentioned this a couple weeks ago too, like we have these other measures. We use trueflation quite a bit to kind of see what the actual like day-to-day inflation number has been. But Trueflation, which is a private company, isn't the one providing data to the Federal Reserve, right? Like so
Correct.
that's where the disconnect is. Like we can kind of see what's happening with prices, but that's not what the Fed is relying on to make their decisions.
Correct. It's a fantastic resource. They look at 80,000 or over 10 million prices per day to develop what the current, as of today, what the inflation rate is in the United States. And I give it a lot of credence for people who want to go check it out. It's trueflation.com. Look at their inflation dashboard. They do a really a great job. And this day and age of big data, it's pretty good. They're really good. Um, Now they don't average things, so there are time series, data series that are not averaged, which many of the official indicators, inflation indicators, include averaging for very good reasons, and they
Hmm.
also have seasonal adjustments. Trueflation doesn't do that. So just to give you an idea as to one's really not better than the other. It's both are really important to understand what the inflation picture looks like today. Um, so yeah, tomorrow we get inflation. Now, this is a interesting data point because from what I understand, it has been announced that they will actually provide the CPI data.
Oh, wow.
So we'll see some people got called back to work to just do this report. So um, we'll see if they get laid off right afterwards. Hopefully not, but that we'll see. That's tomorrow morning, so we'll see how that all comes in. Um, but the overall, and I'm going to say the overall equity markets have been fairly well behaved during the shutdown, which is typical. Typically the equity markets during a shutdown, instead of relying on macroeconomic data, start to focus more on microeconomic data, which is company earnings, right? We
Hmm.
just started the third quarter earnings results, where all the publicly traded companies are now, starting to give out their third quarter earnings releases and to highlight the really positive points and to identify some of the negative happenings during the quarter. And so that's where a lot of equity investors have been focused is those earnings calls, those earnings results. Yesterday, Tesla came out. They beat on revenue. They missed on earnings. So it was kind of a mixed day for them. But again, lots of different companies coming out and some having really good earnings and some not so much, like I just mentioned. But overall, the equity market's doing fairly decently during a period of time that could mean a little more volatility.
So, one thing that you were looking at and noticing is the amount of leverage that's in the system. And so we're gonna do a little bit of education and we're gonna do a little bit of explaining what that means and what we're looking at when we are what are the concerns that are there? What are the possibilities that are there? Like all of these different pieces. So let's go there now. We're talking about margin and what does margin mean in a portfolio? How do you use it? When would you use it? And literally what's happening with it? And then what are the other types of leverage that exist in our financial system as well? So let's start with margin. What is margin,
All right.
first of all?
Margin is effectively just a loan. It's a collateralized loan, meaning I'm going to do easy math. You put $100,000 into an account, into a brokerage account, and let's say you want to buy $150,000 worth of securities. You then buy 150,000. That $50,000 difference is a margin loan from your broker dealer. So the
Mm.
broker dealer comes into agreement with you, says, okay, you have 100,000. That's great. You can buy that in securities. In addition, we'll lend you $50,000 and over and above that 100. So in a total of $150,000 to invest any way you want. Okay. Now there are some caveats to this, obviously. One, it's a loan. It has an interest rate cost to it. And sometimes these margin rates can be pretty elevated.
Mm.
So it's something to be aware of that, yes, it's important to understand how much money they're charging you and what interest rate. Um, if the market goes up 10%, right, in a short period of time, you're up $15,000. So if they're charging you 10, so if they're charging you $5,000 in interest, that's a $10,000 net ahead that you are. Part of it is timing as well. How long does this gain take? Are you really sure that it's going to happen within 6 months? Because, less than a year worth of margin interest may not be that big of a difference. May not be that big of a deal, particularly if your gains are worth it. And that's really what the caveat is. Also, if the market goes against you, what you also have to understand is you have now more exposure to that market.
Hmm.
So if it goes down 10%, so your 150,000 goes down to 135,000, right? Well, that comes all off your equity. Your loan is still $50,000.
Yeah.
Okay. So you don't, the loan doesn't go down, your assets go down. So it has a magnification on the upside and the downside in your portfolio. So if you're right and the your investments go up a lot, great. It can really magnify your returns, increase those returns, fantastic. However, you if it goes down, you're gonna see a bigger loss than you otherwise would in a cash portfolio.
So let's get even more. So that was the technical definition, everyone, on margin.
Yes.
We're gonna go into the CFP version, right? So I'm gonna turn this into human speak. What happens from a margin perspective if you have your own investment account? We'll use that same $100,000. I like that. What you're essentially doing is borrowing against the value of that $100,000. And Brad, to your point, you can use that for anything you want. So actually, let's make the number bigger so that you can understand some more of the uses of it. Say it's $1 million account and you have $1 million worth of securities in your account, and you can borrow up to 50% of that on margin. Okay. So you can borrow up to $500,000 on margin. Just like you said, it has an interest rate. It's not free money. Um, Sometimes it can be negotiable, right? If you have $100 million and you want to take a big margin loan, the bank might work with you a little differently, or the brokerage house. Um, but for the most part, that interest rate is going to be higher than a typical mortgage, let's say, right? Like
Yes,
so
much
what,
higher.
at least what I've been seeing, even and Schwab is one of the places that where we custody assets. They're up at around 9-10%, 9 to 11%, I think, right now on their margin loans. Um, so again, we've got this $1 million account. You can borrow up to $500,000, up to 50% of the value of the account. If you want to buy more stock with that, just like you said, then it's leveraging the amount of growth or magnifying the amount of loss that you're going to experience. But what some people also do is take that margin loan and do something else with it, right? They might buy a house or buy another property or invest in a business. They don't necessarily have to invest in the stock market with that margin loan money. They might use it for other purposes. I did see this happen. People looked at the strategy, used it, especially when interest rates were much, much lower. So I had several clients when we were in like the 2 and 3% range, like, why don't I use margin loan instead of a mortgage, right? For different reasons. We can go into why that might make sense for some people as well at some different points in life. But the same thing holds true. So if you have that $1 million portfolio and you borrow $500,000 to do something else, let's say it is to buy a house, if your portfolio drops, if we experience a 10, 20% drop in the market and your portfolio drops along with it, you're going to have something called a margin call. You're going to have to put more money into the account so that because that the amount of that loan didn't go down and it has to stay at less 50% or less of the portfolio, right?
Well, depends. So margin, the maintenance margin is what it's called, is depending on what you invest in. If it's just in normal large cap dividend paying stocks, generally you'll get to about 35 to 40% equity, meaning
Mm,
your equity has dropped to 35 to 40% of the account value before the broker dealer calls you and says, "Hey, we need to start curing this margin. We need to either raise some cash to pay down part of the margin, or you need to bring cash in from outside sources to help pay down the margin loan." Either way, yeah, they'll start to cure that around 35 to 40%.
okay. So that's one of the big risks that you might experience, right? We call it a margin call. You have to bring the cash up somehow to bring it back into balance. Um,
And just to put a note, when you get a margin call, it is a you have to do something right now, not tomorrow. So
ugh,
it's a little bit of a they do not give you a lot of time. So if you get a margin call, you need to cure that day.
mm,
So
we need to have something right on tap. So with that in mind, what about that? I would love for you to share that chart that's showing just how much margin is in the system right now,
okay.
because that one is super interesting. So even just with that brief description of how that can work, again, the main point being margin is a way to leverage your stocks. It's a way to leverage your portfolio in general and
Yeah,
borrow against it in some way.
yeah, and it can be good, and we'll describe some of the use cases in just a few minutes. But so this is a screen of margin debt, and you'll see it's an area chart. So to walk you through for our audio listeners, it's a chart from 1998 through now through September at the end of September 2025, and it shows the level of margin. Um, and you see these different peaks in March of 2000, July of 2007, May of 2018, October of 21, and then September of 25. And you can see that it's an ascending chart with a lot of volatility in it. But for the most part, you can see big amounts of increase in margin. In fact, we're over $1.1 trillion in margin, which is the largest ever by quite a bit. The prior peak was 900 billion, a little over 900 billion. So that's a cool $200 billion more. So it's nothing to really panic about, but it is something to give us a context that a lot of these recent gains in equities may be driven by leverage as opposed to by people putting savings or investment dollars to work. But instead, they're getting financed dollars and they are buying in. The reason that is critical to understand the difference between financed dollars and savings or just cash investment dollars is because financed dollars, because of that cost of funds, are short-term in nature. They are there for while the going is good, but as soon as the going stops being good, they're going to step off that train really, really quickly and pay back the loans because of that magnification factor in the returns. And so that leveraged amount. So this starts to not it shouldn't panic anyone, but it should give you a context that perhaps right now where we're sitting at the S&P 500 and a lot of the Nasdaq and the really high levels, almost the all-time highs for those indices, some of this is financed by a lot of margin dollars as opposed to cash investment. So you can understand that this could be creating a setting where volatility might increase pretty dramatically if the markets start to pull back.
Yeah, and that magnification effect. like we said, it magnifies both sides, right? It's not, it's, we've talked about this on the podcast before. I'd have to go back and look at which episode it was, but we've talked about options and call options and put options and what options are, and that's another form of leverage on this, the stocks, either stocks that you own or don't own. But those also are magnifiers. And so that means you can, sure, you can like magnify your winnings, you can magnify your gains, but you can also lose more than your original investment, right? Is the way, like the danger that comes with that. And that's why we put this in more of a speculative bucket because of how volatile it can be.
Yeah, you're exactly right. You know, there's margin can be a really great thing. Like I said, on the way up, margin is fantastic because it does magnify your upside. On the way down, though, you want to be really careful about how much risk you take on during a downturn. And so that's why a lot of people who trade with margin are very momentum driven. As long as the momentum is going in the direction that they hoped, they're going to be making a lot of money. But as soon as it turns around, they really need to cut their investment positions quite a bit and pay down that margin. And you'll see that that's why you see like from October 21st, it peaks at just over $900 billion dollars, and then it troughs just over $600 billion dollars in not a very long period of time because people were taking their investments off the board, paying down those debts because the markets were going the other way.
So what I'm hearing you say in conjunction with this chart, which again from 1990, well, it was 2000, 1998 to 2000, it rose up to about 300 billion in margin debt to give context. And then here on the 2025 side of the chart, like you said, it's at 1.1 trillion in margin debt. Is that it leads to more volatility because as the momentum starts to shift, as the market starts to have those very first uh, curves back downward of when institutions are starting to see a slowdown or a pullback coming, they're going to get rid of those margin positions. They're going to pay back those loans very, very quickly in order to try to retain the gains that they had. And so
Correct.
this does I don't think you had this chart in this little set, but does that overlay with, the recessions and the indices? Do they map pretty well with those peaks
Uh,
and troughs?
well, this is actually a delayed. So if I superimposed a S&P 500 chart on this, my guess, this is just a guess because I haven't done it, but I guess I could. Um, if I relayed the returns for the S&P 500 on this, my guess is the peak in margin debt comes after the peak in the S&P 500.
Oh, interesting.
Right? So it peaks first, then it starts to go into a decline, then people start to react and try to pay down their mortgage debts. So
Margin
it's
loans.
margin loans, sorry.
Yeah.
It is again, that is kind of what my supposition would be, and I would expect that to be completely correct. So
So let's talk then. When is margin useful? What type, like at what level um, are we talking? Like, just to give context, like if you have $25,000 to invest, my first instinct would not be to, hey, let's take a margin loan on half of that and put that in, right? Like that's not that we're not talking on small dollar amounts here. Where does that start to become a strategy that we actually talk about with people?
uh, generally, I've used margin to finance certain things, depending on the cost of the margin relative to what they want to buy. So, for example, if we have a client that's very bullish on the economy, on the equity markets, um, then depending on the cost of the margin. and again, what we can get them um, in terms of lending the money, in terms of interest cost, sometimes we will go in and do that. We will, and on a reasonable level. We're not doing 50%. We're doing 25 to 30% to magnify that upside and still control the risk. Um, I do not recommend margin for anybody who's not aggressive and sophisticated in terms of investments, because it can be a shockingly harsh lesson for people to learn, if they don't know what they're doing with it. So we do have people that utilize margins for lots of different reasons. And sometimes it is because they own an asset that, for example, is company stock. They don't want to necessarily sell it because they have a really low cost basis in it, but it's a non-diversified portfolio. It's a concentrated portfolio. So that one stock has a major influence on their financial plan. So sometimes, again, sometimes will say, hey, take out a margin loan. Let's buy a diversified basket of equities and a diversified portfolio for you. And we can mitigate to a certain extent that level of concentration in the portfolio, along with some other strategies that we would do to help control that volatility. But that is one way to do it. Another way is, like you said, if they have other investments they want to pursue, and they have a large investment portfolio with some embedded gains, they don't want to pay the taxes. Sometimes margin loans are an easy, quick, effective way to utilize the cash, and then it gives you some opportunity over time to come up with the cash a different way, whether it's from another investment, whether it is slowly over time allowing the market to go up, pay that interest cost down, and then start to slowly trim that back and pay down that other that margin loan. Um, so yeah, there's lots of different reasons to do it, but generally, again, I would say this is in the sphere of someone who is more aggressive and sophisticated in terms of their balance sheets.
You made a really good point there about embedded gains. So we're talking mainly about non-qualified accounts or non-retirement type accounts,
Yep.
right? Where if
Taxable
you
accounts.
taxable accounts, um, where if you have, let's say you have Apple stock that you bought in the year 2005 and you've had it for 20 years and it has, you know, 1,000% gain on it, that anytime you want to sell that stock or anytime you want to use it, you're going to pay most of the balance of that is going to be capital gain. And so depending on your income, if you're in the 15% or 20% capital gain bucket, you're going to pay, let's say you do have, a high income and you're making $1 million a year, you're going to be paying 20% on those capital gains, because your current income is so high, right?
And probably 23.8%
Oh, yes.
because the 3.8% NIIT.
Right, right. So, I mean, that is a big chunk. And so using margin instead, let's say your margin loan rate comes in at 9%. Well, that's a heck of a lot lower than 20% of a tax that you would have to pay. In addition to that, margin loan interest is potentially also tax deductible in some cases and with some limits. And it has been in the past, has been for a long time, that has been considered a tax deductible expense where like your regular investment management fees are not tax deductible. There are other places where, that doesn't work, but with margin interest, we've had these, I don't know if they're loopholes. They're just, that's the rules of the game as it's being played at the moment. That potentially your margin interest is a deduction for you versus selling the asset and paying that 20 to 23% capital gain tax. So,
Well, that's really what it becomes is how am I going to arbitrage this cost,
right.
right? And if I'm, you know, going to liquidate my portfolio to do something, whether, is it going to cost me capital gains of 23, 24%, or is it going to cost me 9%? Then it buys me flexibility for a year.
Hmm.
And then again, if it's tax deductible, you're in a high income bracket, it really does help out on that front.
Yeah. Yeah, it makes a big difference. So I mean, these are strategies that are worth looking at. But again, like to talk to someone who is able to walk you through it and make sure that like if you're doing it on your own, yeah, it's easy to not get it quite right. And I've seen that happen before too. Unfortunately, I've had clients come to me after they've implemented these strategies on their own, seeing it online or hearing someone talk about it on a podcast, and like, oh, I can go do that by myself. Um, maybe potentially, but my strong recommendation here is talk to an expert when you're utilizing these intricate strategies. So there's our margin primer. And I wanted to also include leverage. We were going to talk about ETFs and the leverage that's also present in the system with ETFs. So we've got more margin loan on the books literally than ever before. It's at all-time highs, that $1.1 trillion of margin debt on the books. Where else do we see leverage in the system?
Yeah, so what you were talking about there was ETFs, and I apologize. I'm trying to get my chart up that shows it wonderfully. Um, so if I'm not looking at you, I don't mean to be rude to all of our viewers and listeners and you. I'm just trying to get this so I can show everyone what it is.
Brad's always the one driving the charts. I'm over here talking. So I'll keep talking. I'll keep
All
going
right,
with
I
that.
got it.
You
I
got
got
it? Okay.
it. So, okay. All right. So, another form of leverage that we have to watch out for is the amount of leveraged ETFs. Now, an ETF, just a reminder, is an exchange traded fund. Essentially, it's just a basket of stocks in one wrapper, and it trades like a stock on the exchange, right? So I'll give you an example. The Spider S&P 500 is the basket of all of the stocks in the Standard and Poor's 500 index, but it trades like a stock on the exchange with the ticker SPY, right? So you can see minute to minute it changes in price, or second to second it changes in price, but you can buy that one instrument, that one security, and own all of the S&P 500. So it's a very quick, effective, efficient, tax efficient way of gaining access. Well, exchange traded funds have become very popular, which is why we discuss them a lot. But in in the ETF industry, a lot of the ETF sponsors or the companies that put them out have started to reach and try to find different niches to separate themselves and gain more trading volume. And one of the niches that they're trying to exploit is by setting up leveraged ETFs. I'll give you an example. Um, if, for example, you wanted to own the S&P 500 index, uh, instead of just having it cash only, so you put 50,000 in, you own 50,000 of it, there are instruments you can go and buy two times the amount. So you buy $50,000 in this ETF, you actually have $100,000 worth of exposure. Okay. So you're leveraged 2 to 1 for your investment. All right. Again, great when the market's going up.
Hmm.
Fantastic, because now you own twice as much than you otherwise would have, but not great when the market's going down. Okay. Because again, you own 2 to 1. So if the market goes down 1%, you're down 2%. If the market goes up 1%, you're up 2%. So that symmetric volatility is important to keep in mind.
Right. So let's go bigger because we've had a couple in the recent volatility. If the market's up 5%, maybe you're up 10%.
Yes.
with
Yep.
that. But if the market has a rough day and it's down 5%, then you just lost 10%.
Yes. Yes, that's a correct. So great when the market's going up, not great when it's going down. But there is embedded leverage in all of these leveraged ETFs. Um, the chart you're looking at the screen goes from 2020 through basically September of 2025, and it's provided by Morningstar Direct, which is the institutional business of Morningstar, and it shows the number of assets in these leveraged ETFs growing from less than 20 billion in 2020 to over 122, 23 billion as of the end of September. So again, is that something to panic with? No, but it's something to talk about in terms of, hey, we're getting a little more leverage in the system between record high margin balances, between record high leveraged ETFs in the system. And what that means is that's called hot money. That's money that's going to move if the market starts to go in the wrong direction. It's going to move very quickly, and it's in and of itself, it's going to cause volatility. Okay. Because people, if you have, let's say, $50,000 in a leveraged ETF and you decide to sell it, that that ETF somehow has to raise $100,000 to fund or to has to raise $50,000, right? Which means they have to sell $100,000 worth of securities to get you your 50,000. So again, that causes more volatility than, and so anytime we've had market highs and leverage is increasing or is at a pretty high level, we just have to be aware of the fact that we are on a more fragile footing than we were otherwise. So it's something that I think clients need to be aware of. In terms of number of products, we now have 701 ETFs that have leverage in their system. Um, Not all are bad. We use leverage ETFs to help reduce the risk in the portfolio. So there are those type out there. But again, most of these are traded by institutional and retail investors that will be selling them once the momentum runs out.
So you sort of answered this question that I had, which was like, I wonder if that's a dumb question, but it's not. It really isn't.
No
Uh,
questions
wh
done.
right, which is well, maybe, but I think this one's actually good. Is where does that money come from? Right? Because if it's leveraged, if it's like, okay, if you win double and then you decide to take if you're in the casino and you win and you want to take your chips off the table, the house has to pay you, right? While you're up. So this is in that same vein. Yeah, like you explained it somewhat, but when you win, when you are up and you decide, hey, that's great. I got some big gains. I'm going to go ahead and take those gains. I'm going to take them off the table. Where does that money come from and what would happen? This is where like the trickle down question is what would happen if everybody did that at the same time?
Yeah, so what I'm showing you is a chart, and I'm going to explain this because it's related to what you're saying, but it's in a very uh, circular way. So the where it
Please, Rich.
comes from is the investment portfolio. Okay. So if I have $100,000 in assets and I have $50,000 in debt and I need to raise $10,000 in cash, right? I sell $10,000 of securities. Okay. Well, do I pay off the loan? Do I keep the loan the same? If we're going to keep the leverage ratio the same, I'm going to have to sell $20,000 because then what happens is I pay off $10,000 of loan and send you your 10 grand. So sometimes there is this um, kind of this relationship cause and effect. It becomes a feedback loop, which is what we're talking about here is when the momentum stops, leverage gives an opportunity, gives a potential for a negative feedback loop
Mm,
where markets go down, leveraged people start to sell to reduce their leverage, and then that requires their institution to sell, which requires and it just starts to cascade as more people start to sell, and then it becomes this accelerating downside. That is what happened in 1987. In October of 1987, during that crash, was effectively everybody had contracts that once the momentum broke and started going south, it reinforced that negative, that decline to a
yeah.
point where it was 29% in one day.
Well, that happened again in, was it 2015 or 2018? Like,
Yep.
was it 20? It was 2015, wasn't it?
Yeah, I
Like
think so.
New Year's, or not New Year's, Christmas Eve. I feel like we got into a negative, that negative spiral of like, whoop, now we're hitting lows and more triggers are being hit and more triggers are being hit and more people
Yeah.
are selling. Yeah.
And it happens during any large downside because people start to do it to trim their leverage, and it accelerates through all of the different types of investors all the way down to as you get near the bottom of the peak of the decline, you get the people that are just so uncomfortable with the risk, they just want to preserve their capital. So then they end up selling out at the wrong time. Well, that's how you know from a behavioral standpoint, that's how you know a decline is almost done, is you have those type of people coming to you and saying, I just have to preserve my capital, and your job is to keep them in their long-term, investment plan and financial
Hmm.
plan so that they don't harm themselves. Okay. That they can continue to get through that really difficult period. Now, what I'm showing you is a chart, and this is um, part of the money comes from uh, the banks that finance the ETF companies or the mutual fund companies, the hedge funds, the private equity, the private credit. All of those are funded by banks as well. So that's part of banking, right?
Mm,
Correspondent banking, private banking, prime finance, prime brokerage, all of that is just different names for lending money to NDFIs, which is non-depository financial institutions. These are institutions that do not take deposits from outside clients. They take investments and then they leveraged those investments with a loan from the bank. Okay.
okay.
Now, that could be these ETFs. So, for example, ETFs generally have a line of credit on top that if they get too many redemptions too quickly, instead of having to sell, right, they're going to borrow off their line of credit to fund the distributions to provide that liquidity to their clients. Great, phenomenal, works 90% of the time. The time where it becomes a problem is when we're in that self-reinforcing decline. Okay. Now, what I'm showing you is the growth. The blue line it shows from 2015 to 2025. It shows the growth in lending to non-depository financial institutions. It is up 350% since that time period. Okay. Now, to compare that, your commercial real estate is up about 70% over that same time period. So again, commercial real estate, much, much larger market. Non-depository financial institutions, much smaller market, but yet growing very, very quickly on a relative basis. So I want to tell people that this is where you'll start to see if we go through a really bad downturn, which I don't expect. So this is not what I expect. Please do not panic on this. This is not what I expect, but you'll start to hear if credit quality goes, if all of a sudden we have a pullback, we start to have that acceleration as people sell because other people are selling and they're lowering their leverage. You'll start to hear concerns about banks that have done lending to these non-depository financial institutions. How how good are those loans? And usually it's, again, like I said, 90% of the time, not a big deal. 10% of the time, it's a big deal. So it's just something to be aware of.
And so, as a takeaway from this conversation today, one, education piece, right? As far as like understanding what margin is, how you use it, um, but also what would be your takeaway from this for people to understand?
One, leverage is a double, it's a dual, it's a two-edged sword. It can do really, really good things for you if you know how to use it properly, or it can do very, very bad things if you don't know how to use it properly. I would suggest if you're having a financing issue or if you you want to pursue some other financial goals with other investments, talk to your financial advisor about how the best way to finance those. Generally, we have contacts and we know the specifications of what they're looking for, and we can place you with the right type of debt for that investment. And so that's what I would say is, look, margins out there, it's high, asset prices are high. So again, um, it's just a context, nothing to panic about. We're also at the beginning of a huge innovation cycle with artificial intelligence, robotics, all of those things, which will help each company become more profitable for every dollar they bring in sales. So again, that's a really long-term trend, and we're just scratching the surface of it. So don't think that I think margin is all bad, because it's not. It's just has to be used in the proper place for the proper purpose.
Beautiful. Well, thank you, Brad, for that and for going over that with us today. And as always, if you, the listener, have any questions, any topics that you're interested in, wanting to learn more about, send us a note, send us an email. All of our contact information is down in the show notes, and we'll see what next week. Next week is October 30th. We're supposed to have some data, so we'll see how that goes, right?
Yep,
All right. Well, thank you so much again, Brad, and we'll see you next week.
sounds good.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.